Swayam Prabha. Digital India. Educated India.
Yogah karmasu kaushalam.
Hello everyone, I am Dr. Chetna Marvadi, Associate Professor, School of Commerce, Gujarat University. Today, we will study Part 2 of Process Costing. Let's revise. In the previous Part 1, we have studied about number 1, what is process costing, number 2, how it is different than other costing methods like unit costing and contract costing, number 3, industries where process costing is applied. Number 4, what procedure should be followed to make effective ascertainment of process cost. Number 5, a detailed study on difference between job costing and process costing. Number 6, features of process costing. Number 7, elements of cost of each process. Number 8, some important points to be noted for understanding process costing precisely. And we have also studied the format of process account where different components are disclosed. We have also understanding the process account through simple illustration where different processes are involved. Now, learning objective of Part 2 are: first, to understand theory of some important aspects of process costing like normal loss, abnormal loss and abnormal gain. Second, to understand normal loss, abnormal loss and abnormal gain with appropriate illustration. Third, to understand accounting treatment of normal loss account, abnormal loss account and abnormal gain account. Some aspects of process account are of great importance. They influence the cost of each process. Their proper understanding and clarity about accounting treatment of these aspects would remove hurdles to understand process accounts. These aspects are: number 1, normal loss, number 2, abnormal loss, number 3, abnormal gain. In most industries where process costing is in use, some loss, scrap, wastage, etc. is inevitable. It is essential that accurate records should be maintained to control such loss or wastage. The loss or wastage likely to arise must be reasonable. The figure for the reasonable loss or wastage in respect of each process would be ascertained on the basis of past experience or scientific estimates. This reveals the loss or wastage which could be expected in normal conditions and is considered to be the normal process loss or wastage. Anything above this normal limit would be treated as abnormal. Conversely, loss or wastage below this normal limit would be treated as abnormal gain or effectives. Normal and abnormal process losses must be distinguished. That loss which is unavoidable because of the nature of material or the process is normal process loss and must be treated for costing purposes as an additional charge to the usable units produced. Let us see all these in detail with illustration. First, we will understand normal loss. Normal process loss means the loss of material which is inherent in the manufacturing operation due to chemical changes or other physical factors will be treated as normal process loss. Normal process loss should be absorbed by good units produced. Hence, normal wastage is credited to process account concerned in terms of quantity only, and its process cost should be allowed to fall on the good units produced. If any reduction in quantity due to inherent quality of input is treated as weight loss and it will not have any realizable value. However, any value that can be realized on the sale of wastage as scrap should be credited to the process account concerned. Thus, first, as normal wastage is inevitable, its loss must be spread over good units produced. For this, the number of units of normal wastage must be credited to process account concerned. Second, if any price is realized by selling this normal wastage, it should be credited to process account. Third, the total cost of the process less price realized from normal wastage is treated as a normal cost and it must be divided by the number of good unit produced, that is normal production, to get per unit cost of production. Let us understand this with the help of illustration. Illustration 1. X Company Limited had introduced 10,000 units at rupees 8 per unit in a process during the month of April 2024. Wages were rupees 40,000 and overhead expenses were rupees 17,000. The normal loss is 10% of the units introduced and is sold at rupees 2 per unit. Determine total cost and per unit cost of the process. Let us prepare solution. Let us prepare this process account. As you all know, process account has 6 columns, 3 on debit side and 3 on credit side, which are particulars, units and amount rupees. On debit side, we will write first to materials account 10,000 units, its value is 80,000 rupees, and on credit side we will write by normal loss account, which is of 1000 units and its realizable value is rupees 2 per unit, therefore giving us rupees 2000. Let us prepare process account. You all know that process account has 6 columns, 3 columns on debit side and 3 columns on credit side, which are particulars, unit and amount rupees. On debit side, first is to materials account 10,000 units introduced at rupees 8 and amount comes to rupees 80,000. The next is to wages account rupees 40,000. Next is to overhead account rupees 17,000. And on credit side, by normal loss account 1000 unit, which is sold at rupees 2 per unit, giving us value of rupees 2000. So, in units column we will write 1000 units and in amount column we will write 2000 rupees, and the balancing figure will be transferred to the next process. Therefore, by next process account will come to 9000 units and its value is 1,35,000, which is again a balancing figure, that is a difference between total of debit side, which is 1,37,000, minus realization from normal loss rupees 2000, giving us rupees 1,35,000. In case of normal loss, cost of process will be determined with the help of formula, and the formula is process cost per unit is equal to total cost less realization from normal loss divided by total units introduced less units of normal loss, which is equal to rupees 1,37,000 less rupees 2,000 divided by 10,000 units less 1,000 units, which will give us rupees 1,35,000 divided by 9,000 units, which is giving us per unit value as rupees 15. Total cost of production is equal to materials 80,000, wages 40,000, overhead 17,000 equal to rupees 1,37,000. Total units introduced 10,000 units, of which 10% is the normal wastage. This comes to 1,000 units. If they are sold, they will realize 1,000 units into rupees 2, which is equal to rupees 2,000. This rupees 2,000 will be credited to process account, so that cost of production of that process is reduced to that extent. Normal production is equal to 10,000 units minus 1,000 units of normal loss, giving us normal production is equal to 9,000 units. Normal cost is equal to rupees 1,37,000 minus 2,000 sale of wastage, giving us normal cost of rupees 1,35,000. Therefore, cost per unit is equal to rupees 1,35,000 divided by 9,000 units. Now, let us pass the journal entry on realization of normal loss. This realization always reduces the overall cost of respective process, and the entry is bank account debit rupees 2,000 or normal loss account debit rupees 2,000 to process account rupees 2,000. This cost of rupees 15 includes cost of normal wastage also. Note that actual units produced were not given. It indicates that there is no variation in the actual production. Actual production is units introduced less units of normal loss. In this case, it is 9,000 units. Secondly, we will discuss about abnormal loss. Let us understand abnormal loss or wastage. It is wastage in excess of normal expected wastage, which is known as abnormal loss or wastage. It is caused by unexpected or abnormal conditions such as substandard materials, carelessness or inefficiency of workers, accidents, bad plant designs, etc. This type of loss or wastage must be thoroughly investigated and necessary steps must be taken to prevent any reoccurrence. Abnormal process loss arises due to special circumstances, and the extent thereof will vary in different circumstances. Such abnormal loss is not separated and is not allowed to affect the cost of good units, otherwise cost of production will fluctuate and misleading information will be available. The cost of abnormal wastage should be valued as if they are good units and should be transferred to a separate abnormal loss or wastage account. The causes of such abnormal wastage should be investigated and it should be charged to profit and loss account. In order to find out the cost of abnormal wastage or loss, the proper formula should be used. The formula for cost determination of abnormal loss is equal to, first formula is cost of abnormal loss is equal to units of abnormal loss multiply with process cost per unit. That is, and process cost per unit is equal to total cost less realization from normal loss divided by total units introduced less units of normal loss. Or the second formula for calculation of cost of abnormal loss is cost of abnormal loss is equal to into bracket total cost less realization from normal loss divided by total units introduced less units of normal loss bracket close into units of abnormal loss. Note that the formula for cost determination of abnormal loss and abnormal gain would remain same, only difference is whenever there is abnormal loss, units of abnormal loss are to be taken, and in case of abnormal gain, units of abnormal gain are to be taken. Let us understand it with illustration. Illustration number 2. X Company Limited had introduces 10,000 units at rupees 8 per unit in a process during the month of April 2024. Wages were rupees 40,000 and overhead expenses were rupees 17,000. The normal loss is 10% of the units introduced and it is sold at rupees 2 per unit. Actual production is 8,500 units. Determine total cost and per unit cost of process. Let us prepare the solution. We will prepare process account with 6 columns, 3 on debit side and 3 on credit side. First we will record entry for debit side to materials account 10,000 units which are introduced at rupees 8 per unit giving value rupees 80,000, and in units column we will write 10,000 units. Then to wages account rupees 40,000, to overhead account rupees 17,000, the expenses of process account given. On credit side we will write by normal loss account, our normal loss given is 1000 units. So, in unit column we will write 1000 units and it is sold at rupees 2 per unit. Therefore, our realization value comes to rupees 2000. The next entry is by next process account which is 8,500 units, that is our finished product of this process, rupees amount is 1,27,500 and the difference is of 500 units as we have introduced 10,000 units, 1000 unit is normal loss. So, we should have produced 9,000 units, instead our production is 8,500 units only. Therefore, there is abnormal loss of 500 units. So, by abnormal loss account 500 units and its value comes to rupees 7,500. Let us understand the calculation of abnormal loss. In this question, actual production is given and that is 8,500, while expected actual production must be equal to units introduced less normal loss. In this case, expected actual production is 9,000 units, but actual production is of 8,500 units. It means loss of 500 units is abnormal loss. Let us understand this in the form of table. Units introduced 10,000 units less normal loss 10%, that is 1000 units. Therefore, our expected actual production comes to 9,000 units, but our actual production is 8,500 units and therefore, abnormal loss of 500 units. When expected actual production is less than the actual production, the difference is abnormal loss, but when expected actual production is greater than the actual production, the difference is abnormal gain. In our case, we have abnormal loss. Thus, its cost is to be determined through explained formula, which is cost of abnormal loss is equal to units of abnormal loss into process cost per unit. process cost per unit is equal to total cost less realization from normal loss divided by total units introduced less units of normal loss. So, process cost per unit is equal to rupees 1,37,000 less rupees 2,000 divided by 10,000 units less 1,000 units, which will give us rupees 15. Therefore, cost of abnormal loss is equal to 500 units or rupees 15, which is equal to rupees 7,500, or we can calculate cost of abnormal loss using another formula. Cost of abnormal loss is equal to total cost less realization from normal loss divided by total units introduced less units of normal loss into units of abnormal loss, which is equal to into bracket rupees 1,37,000 less rupees 2,000 divided by 10,000 units less 1,000 units bracket close into 500 units, which will give us rupees 7,500. Now, let us understand journal entry for abnormal loss. Abnormal loss account debit to process account, this is our journal entry. Now, let us understand the next concept, which is abnormal gain or effective. If the actual process loss or wastage is less than the normal process loss or wastage, then it is considered as an abnormal gain or effectives. The value of abnormal gain is calculated in the same manner as that of abnormal loss and is credited to abnormal gains account. Abnormal loss means reduction in normal loss. Due to this abnormal gain, to the extent of units of abnormal gain, firm will have loss of scrap value. The shortfall in the scrap value of normal wastage is debited to abnormal gains account and the balance is credited to profit and loss account. Formula for cost determination of abnormal gain is cost of abnormal gain is equal to units of abnormal gain into process cost per unit. Process cost per unit is equal to total cost less realization from normal loss divided by total units introduced less units of normal loss, or we can calculate using another formula. Cost of abnormal gain is equal to into bracket total cost less realization from normal loss divided by total units introduced less units of normal loss bracket close into units of abnormal gain. Special note that it is important to note that per unit cost of actual production and abnormal loss or actual production and actual gain shall be same. Let us understand it with illustration. Illustration number 3. X Company Limited had introduces 10,000 units at rupees 8 per unit in a process during the month of April 2024. The wages were rupees 40,000 and the overhead expenses were rupees 17,000. The normal loss is 10% of the units introduced and is sold at rupees 2 per unit. Actual production is 9,300 units. On this basis, we calculate the cost of production of that process per unit. Let us prepare the solution. Let us prepare process account with 6 columns, 3 on debit side and 3 on credit side. First, we will write on debit side. To materials account, 10,000 units is introduced at rupees 8. Therefore, in units column, it is 10,000 units and rupees is 80,000. The next is to wages account, rupees 40,000. To overheads account, rupees 17,000. On credit side, by normal loss account, 1,000 units which are sold at rupees 2, in unit column 1,000 and in amount column rupees 2,000. And by next process account, units to be transferred is 9300 units and its value is rupees 1,39,500. Here the difference is of 300 units and which is of abnormal gain. So, on debit side we will write to abnormal gain account units 300 and its value comes to rupees 4,500 and total on debit side is rupees 1,41,500 and on credit side is rupees 1,41,500. We will understand computation of abnormal gain. In this question, actual production is given and that is 9300 units, while actual production must be equal to units introduced less normal loss. In our case, units introduced 10,000 units less normal loss 10%, that is 1000 units, giving us 9000 units as expected actual production, but our actual production comes to 9300 units. Therefore, there is abnormal gain of 300 units. When the expected actual production is less than the actual production, the difference is abnormal loss, but when expected actual production is greater than actual production, the difference is abnormal gain. In our case, we have abnormal gain. Thus, its cost is to be determined through the explained formula, which is cost of abnormal gain is equal to units of abnormal gain into process cost per unit, and process cost per unit is equal to total cost less realization from normal loss divided by total units introduced less units of normal loss. Therefore, process cost per unit is equal to rupees 1,37,000 less rupees 2,000 divided by 10,000 units less 1,000 unit, which is equal to rupees 15 per unit, and therefore, our cost of abnormal gain is equal to 300 units into rupees 15, giving us value of rupees 4,500, or it can be calculated using another formula, which is cost of abnormal gain is equal to into bracket total cost less realization from normal loss divided by total units introduced less units of normal loss into units of abnormal gain, which is equal to into bracket rupees 1,37,000 less rupees 2,000 divided by 10,000 units less 1,000 units bracket close into 300 units, which is equal to rupees 4,500. Let us pass the journal entry. Journal entry for abnormal loss. A reverse journal entry of abnormal loss will be passed for abnormal gain. So, here process account debit to abnormal gain account. Let us understand scrap value of loss. The accounting treatment of scrap value of loss is as follows. First, revenue or sales value from scrap is not treated as an addition to the sales revenue, but as a reduction in the cost of that process. Second, the scrap value of normal loss is therefore used to reduce the material cost of the process. It is credited to that process account. If we make a journal entry, scrap account is debited and process account is credited. Second, the scrap value of abnormal loss is used to reduce the cost of abnormal loss. Thus, the loss of abnormal loss debited to profit and loss account will be reduced to that extent. The entry is to debit scrap account and credit abnormal loss account. Third, in case of abnormal gain, there is no sale proceeds of scrap because they are sold as good units. Thus, the sale proceeds of scrap are reduced to that extent. the accounting entry is to debit abnormal gain account with the sell price of abnormal gain and credit scrap account. This will reduce the profit of abnormal gain. Fifth and finally, the cash received from sale of scrap is debited to cash account and credited to scrap account with the value of actual number of units scrapped. Let us see the treatment of scrap with the help of an illustration. Illustration number 4. In a factory, 5000 units are introduced into a process at a cost of rupees 1 lakh. The total additional expenditure incurred by the process is rupees 1,65,000. From the past experience, it is calculated that of the units introduced, 20% are normally spoilt in the course of manufacture. This possesses a scrap value of rupees 5 per unit. Prepare process account if the output is as follow. Situation 1, 4000 units produced. Situation 2, 3500 units produced, and situation 3, 4200 units produced. Assume that abnormal wastage possesses the same scrap value as the normal wastages. Let us prepare the solution. Let us see the position of loss or gain in the given situation. Let us see the position of loss or gain in the given situation. We will prepare 3 columns for 3 cases. First case is when production is 4000 units, second case when production is 3500 units, and third case when production is 4200 units. For each case, we will prepare 2 columns, particulars and units. For first, when the production is 4000 units, units introduced 5000 units, normal loss 20% which is 1000, therefore expected actual production 4000, actual production is also 4000 units, therefore there is no abnormal loss or gain. In second situation, when the production is 3500 units, units introduced 5000, normal loss 20% that is 1000 units, our expected actual production comes to 4000, but actual production is only 3500 units, giving us abnormal loss of 500 units. And in third case, when production is 4200 units, units introduced 5000 units, normal loss 20% that is 1000, expected actual production 4000, but our actual production is 4200 units, giving us abnormal gain of 200 units. Now, let us understand these 3 situations by preparing process account. In first case, there is neither abnormal loss or abnormal gain are reported. Thus, no other account is required to open. So, we will prepare first process account where 4000 units are produced. You know the format of process account in 6 column, 3 on debit side and 3 on credit side. First, we will record on debit side. So, to material account, units introduced 5000 units and its value is rupees 1 lakh, and to bank account for other expenses as given in example rupees 1,65,000. Therefore, total of debit side is 2,65,000 rupees with 5000 units. On credit side, by normal loss account 1000 units and value is rupees 5000, and by next process account amount comes to rupees 2,60,000, which is rupees 2,65,000 minus normal loss of 5000, and the units is 4000 units. Here per unit cost is equal to rupees 2,60,000 divided by 4000 units, which is equal to rupees 65. Now, let us prepare for second case where we have abnormal loss. In second case, abnormal loss is reported. Thus, abnormal loss account will be opened. We will prepare first process account where 3500 units are produced. On debit side, we will write to material account for units introduced 5000 units, value is rupees 1 lakh, to bank account for other expenses rupees 1,65,000, giving total of debit side rupees 2,65,000 with 5000 units. On credit side, as usual, our first entry is for normal loss. So, by normal loss account 1000 units, amount is 5000 rupees, and by next process account units transferred are 3500 units and its value comes to rupees 2,27,500, and per unit cost is rupees 2,27,500 divided by 3500, which is equal to rupees 65. And last one on credit side is abnormal loss account, and the balancing figure is rupees 32,500 and units are 500. Therefore, making total of credit side 2,65,000. Let us understand the calculation. Cost of abnormal loss is equal to total cost less realization from normal loss divided by total units introduced less units of normal loss, and this amount is to be multiplied with units of abnormal loss. You are well versed with this formula, which is equal to rupees 2,65,000 less 5,000 divided by 5,000 units less 1,000 units into 500 units, which will give us the value of abnormal loss as rupees 32,500. Here we are required to prepare abnormal loss account. Let us prepare this account. Abnormal loss account, on debit side we will write to process account, which is of 500 units and its value we have calculated as rupees 32,500. On credit side, by bank account, units is 500 units and it is sold at rupees 5 per unit. Therefore, amount comes to rupees 2,500 and the balancing figure comes to rupees 30,000, that is transferred to profit and loss account. Therefore, the last entry is by profit and loss account rupees 30,000. Abnormal loss is additional loss, and from this loss there will be realization on this loss as per the rate of normal loss. Normal loss is sold at rupees 5 per unit and this abnormal loss also will be sold at rupees 5 per unit. The remaining amount of abnormal loss will be transferred to profit and loss account. Journal entry is to abnormal loss account debit 32,500 to process account 32,500. Second, bank account debit rupees 2,500 or profit and loss account debit rupees 30,000 to abnormal loss account 32,500. Let us see the third situation. In the third case, abnormal gain is reported. Thus, abnormal gain account will be opened where 4,200 units were produced. Let us prepare process account in the situation where 4,200 units are produced. On debit side, we will write to material account, units introduced 5,000 units and value is rupees 1 lakh. To bank account for the other expense rupees 1,65,000. On credit side, by normal loss account 1000 units, value is 5,000 rupees, and by next process account units transferred are 4,200 units and the value is 2,73,000 rupees, and per unit cost comes to rupees 2,27,500 divided by 3,500 units, which is equal to rupees 65. Total of credit side is 2,78,000 less value of normal loss is rupees 5,000. Therefore, giving value of balancing figure to be transferred to the next process as rupees 2,73,000. our total of credit side is greater, that is 2,78,000, and therefore, there is a balancing figure of rupees 13,000 and units also of 200 units, and which is our abnormal gain. Therefore, we will write to abnormal gain account balancing figure 200 units with 13,000 rupees. Cost of abnormal gain is equal to into bracket total cost less realization from normal loss divided by total units introduced less units of normal loss bracket complete into units of abnormal gain, which is equal to into bracket rupees 2,65,000 less rupees 5,000 divided by 5,000 units less 1,000 units bracket close into 200 units, which will give us rupees 13,000. We are required to prepare abnormal gain account. Let us prepare abnormal gain account. In the abnormal gain account, on debit side, to loss on realization of normal loss account 200 units and its value is 1000 rupees, and on credit side by process account 200 units value we have calculated rupees 13,000, and therefore, there is a difference of 12,000 rupees, which is our profit, and that is to be transferred to profit and loss account. To profit and loss account rupees 12,000. Abnormal gain is reduction in normal loss, and from this gain there will be realization loss on normal loss. Expected realization on normal loss was 1000 units into rupees 5, which is equal to rupees 5,000, and abnormal gain 200 units resultant in to reduction in normal loss, and now normal loss will be 800 units into 5, which is equal to rupees 4,000 will be realized. Thus, there will be loss on realization of normal loss of rupees 1,000, that is rupees 5,000 less rupees 4,000. Normal loss is sold at rupees 5 per unit, and this also will be sold at rupees 5 per unit. The remaining amount of abnormal loss will be transferred to profit and loss account. Journal entry is first process account debit rupees 13,000 to abnormal gain account rupees 13,000, and second abnormal gain account debit rupees 13,000 to loss on realization of normal loss account rupees 1,000 and to profit and loss account rupees 12,000. In this part 2 of process account, we have dealt with first important aspects of process costing like normal loss, abnormal loss and abnormal gain. Second, studied about normal loss and abnormal gain with appropriate illustration. Third, studied accounting treatment of normal loss account, abnormal loss account and abnormal gain account. Fourth, how to deal with realization of normal and abnormal loss, abnormal gain that we have studied. Fifth, how to determine cost of abnormal loss and abnormal gain. Seventh, further we have studied that realization of normal loss reduces total cost. Next we have studied abnormal gain and abnormal loss are transferred to profit and loss account. We have calculated per unit cost of abnormal loss and abnormal gain, which is always identical to cost of actual production. I hope you have understood this very clearly. I hope you like this session. Thank you.